My name is Tom Clendon, and I am an ACCA SBR expert tutor. And the reason that you're watching this video today is because you've already done this question. You know, you're only going to get the maximum benefit of this debrief of question 1 Whitaker if you've already done it, attempted it, made some mistakes, got some things right. What I'm going to be doing in this video is working the question through, showing you how I would put together the answer. And I'm going to do that in an holistic way. And I want you not only to engage with question 1, but I have also debriefed question 2 and question 3 and question 4, all with added value. So, assuming that you have already done this question, let's get stuck in to my debrief of question 1, Whitaker. Now, the style of my debrief is that I'm going to be working this question. I'm going to be approaching this question as a good student, with structure, reading the information within the question and providing an answer. I'm not just copy and pasting. I'm not just going to regurgitate the official answer. I'm going to try and engage with the question, and from time to time I will pause and we can reflect on the marking guide as to how well that I am doing. Now, the first place to start in a question is to read this information here in the centre. To be blunt, there's not a lot of information gained here other than the fact that our year end is 31st December X5. The first thing I always do is open up the requirements, and ironically, I don't actually even read the requirements. I control copy paste, control copy C, and then I paste that into the word response area. So with a control V with a paste, and then I can reformat the answer to the extent that the requirement, I can reformat my answer to the extent that the requirement needs it. Now, question 1 is always on groups, and question 1 is always going to involve a pre-populated spreadsheet that you are updating. But although there are numbers there, there's also words. And I think it's useful to have a brief overview of the requirement, because my top tip in approaching question 1 is to do it holistically and to do it and to follow a structure. So what have we got? Using Exhibit 1. So we only look at Exhibit 1 for this. Explain why Christian should be classified as a joint venture, 4 marks. Pretty straightforward, only a few marks, and you can see we've got Exhibit 1. Using Exhibit 2, there's a story about impairment where we are explaining and we're calculating and we're allocating. And this is all to do with a cash generating unit, 10 marks, 18 minutes, much more chunky. Exhibit 3 is about Freeman and about how we've bought additional shares. So that could be a step acquisition if we're gaining control, or it could be a reduction in the non-controlling interest if it's a control-to-control transaction. 6 marks. As you will always have, you're going to have to adjust the pre-populated spreadsheet in response to Exhibit 1, 2 and 3. Now, I only want to do this question once. So that means I'm going to do A and D, B and D, C and D. I'm going to work it holistically. As I sort out the joint arrangement, I will then do part D. As I sort out the impairment, I will then do part D. What I'm not going to do is just A, just B, just C, and then only worry about D. No. I do the answer holistically. This exhibit I never really open because actually it's the pre-populated spreadsheet. The information is already given to me here. So I'll open this and I'll sort this out, yeah, as and when I get to it. The next thing I want to do, yeah, to keep my flow, to keep my energy going, is to look at Exhibit 1 and to think about, in Exhibit 1, yeah, why it should be classified as a joint venture. It is a joint venture. Don't correct it. It is a joint venture. But why is it a joint venture? So we've got this information, and we've got this information which tells us that we have bought 30% of the shares. When do we buy the shares? Halfway through the year. Our year end is 31st December. And we bought them for 1.9 million. Now, this has been recorded as a non-current asset. So nothing has been done to that investment, which we know is a joint venture and should be accounted for as a joint venture. We bought 30%. Alistair bought 55%. If you buy 30%, you might think it's an associate as a starting point, but you're told it's a joint venture. Now, Alistair's got 55%, and then there's other shareholders, but there are documented discussions which require decisions to have an 85% majority. Now I understand why it is joint control, because the 30 and the 55 together give us that joint control. There are two types of joint arrangements. Yeah, they can be a joint operation or a joint venture. But neither party has rights to the assets or obligations for the liabilities, and therefore, because you own shares, this is not a joint operation. It is specifically an equity accounting, joint venture. And then we've got the numbers, and we can come back and have a look at the numbers. How am I going to earn those 4 marks? I think this is relatively low-hanging fruit. I'm going to start by defining a joint arrangement. And a joint arrangement is where one or more parties have joint control. And we soon need to get into the application, don't we? We soon need to be practical here. And for the avoidance of any doubt, Christian is not a sub of Alistair, despite the fact that he owns 55%, because of the agreement. Because of the agreement. But I could get lost. I could get lost in that point, and I think I need to effectively move on and make sure that I continue to pick up marks. I've said it's a joint arrangement. Now, it's a joint venture. It's correctly disclassified as a joint venture, because Whitaker owns shares, in Christian, and that gives a right to the net assets and not to individual assets or obligations for individual liabilities. So, that's the justification. And I do think you do need to justify for individual obligations. So as a joint venture, equity accounting is applied. As a joint venture, equity accounting is applied. Now, let me just pause for a second here, because this is worth 4 marks, and I'm comfortable that what I'm doing here is earning those 4 marks. And what I don't want to do is to leave the headspace of dealing with Clendon. I want to get on with the numbers, and I want to address here effectively part D of the question, and I'm going to do my calculations. Halfway through the year, we buy into the company, and in our year end the reported profits are 1.4, the reported gains on the debt investments are 600, and both amounts accrue evenly throughout the year. Now, when you've got equity accounting, you're dealing with the share of the profits. So the profits are 1.4 million. The profits are 1.4 million, but those profits have accrued evenly over the accounting period, and we've only had it for 6 months of the year. Now, I know you could do this in a spreadsheet. I know there's a calculator function, but actually I'm quite comfortable dealing with this as mental maths. Half of 1400 is 700, and therefore 30% of 700 is 2,000, 210,000. Now, that's gone through the P&L. If it goes through the P&L, it's in retained earnings. If it goes through OCI, then in equity, it's going to appear in other comprehensive equity. So the joint venture's been making gains which have gone through equity, so we can claim our share of those as well. Our share of those is 30% of 600. And if our share of those is 30% of 600, we are going to deal with that as 6/12. If we're dealing with that as 6/12, that's 300. Yeah, half of 600 is 300. 30% is 180,000. So in terms of the look of the overall statement, of the overall pre-populated spreadsheet, we've got over here, oh, my mental maths isn't good, is it? Half of 600 is 300. Half of 600 is 300. 30% of 300 is, 90. So therefore, overall, we've got a total of, 300,000. Now, maybe I could have put that in a table, would have been slightly neater, but I'm moving on. And I'm moving on in order to update the pre-populated spreadsheet. So here is my answer response form. Here I am in looking at the idea of Clendon. I'm making the adjustments and I'm wanting to update the joint venture. But the joint venture is nowhere to be found. So let me just remind myself where the joint venture appeared. It recorded the shares as a non-current asset measured at cost of 1.9 million. So we've got that as a non-current asset. We are specifically told that it's a non-current asset. So I need to take it out. So I'm taking it out of non-current assets. I then need to put it in somewhere, and I can put it in as an investment in Clendon, as a joint venture, and I can put it in as 1900. And that's the initial recognition. What I've then got is the equity accounting that I am applying. Now, you've got to make sure you understand we're dealing with thousands here. So I'm going to not deal with those 210. So it's a total extra of 300. It's a total extra of 300. And that extra 300 is going to boost my retained earnings by 210 and is going to boost my other components of equity. I haven't got another components of equity, so I need to open up an other components of equity. I'm going to boost the other components of equity by 90. Time out. Time out. How many marks do you think I have earned already? Well, let's have a think. I am confident that this answer here is worth 4 out of 4. Okay? So the narrative is worth 4 out of 4. When I look at the numbers and the marking guide, I have put in to the pre-populated spreadsheet 5 numbers. 1, 2, 3, 4, 5. That's 5 marks. And I've done a calculation in order to arrive at those numbers. That's 6 marks. Ladies and gentlemen, so far, I have earned 10 marks. 18 minutes is the budget, 20 minutes is the budget for earning those 10 marks. We deal with part A and part D at the same time. I haven't even read about part B. I haven't even thought about part B. Part B is now coming up. That's the next thing on my agenda. So let's carry on this stream of consciousness. Let's have a look what part B is asking us to do. And what part B is asking us to do is quite a few things, but it's all about impairment. We've got to explain, we've got to calculate, and we've got to allocate. We've got various things we're doing for 10 marks in respect of Kennedy. Now, I need, therefore, to be comfortable with understanding the information that we've got about Kennedy. And we've actually got, I think, quite a lot of information. We've got some numbers there, and we can obviously deal with the numbers second. I say obviously. I think the easier marks are in the words and in the explanations. Now, we've got control of Kennedy. We've got a 70% relationship. So we own 70, NCI is 30%. Kennedy is a sub and is a CGU, is a cash generating unit. So we'll do the impairment review on Kennedy's net assets and goodwill. There's a fair value adjustment on land of 190. Land doesn't depreciate. It's still owned. The goodwill on acquisition was 318. So we know the goodwill on acquisition is 318. And we know that, it's measured as a proportion of the net assets. So we've got it as a proportion. So when we come to do the impairment review, we're going to have to do that notional grossing up. At our year end, we've done the impairment review. It is impaired and it's not been accounted for. So the impairment has not been accounted for. So we've got a blank sheet. We don't have to correct anything. We just put the impairment review process. We've got a value in use of 3.8. So we've got a value in use of 3.8. That's given to us. That's part of it. And we've got a fair value less cost to sell. And we've got a fair value less cost to sell at 3.85. So we're going to have to make a judgment call as to which of those two is the recoverable amount. Now, we're then told that the measurement here excludes the cash flow of current assets and total liabilities. And then we've got a load of numbers. So I want to make sure that I pick up the low-hanging fruit. So I'm going to start with a little bit of theory. I'm writing in short, sharp sentences. I'm saying things and I'm using the name of Kennedy. I'm picking up, I'm hoping 1 mark per valid point. So we're saying there's an annual impairment review. We're saying that the loss is first going to be allocated to the goodwill. And we're told the recoverable amount, we're telling the recoverable amount is the higher of the fair value less cost to sell and the value in use. Now we've got those numbers. So the value in use is 3.8. So the value in use is 3.8 million. And we're told that the fair value less cost of disposal is 3.85. So the fair value of cost of disposal is 3.85. So that's what we're told. Now we can therefore, I think, make a judgment that it's 3.85, is the recoverable amount. The asset, in other words, is going to be sold. So what else is low-hanging fruit? And I think it's around that the goodwill has been measured at a proportion, and that in itself creates the idea that goodwill is only attributable to the parent, blah-de-blah-de-blah-de-blah-de-blah. Now, when you're doing an impairment review with NCI measured as a proportion of net assets, the goodwill is going to have to be notionally grossed up. So how much is the goodwill that we've got? It's 318,000. So we've got goodwill of 318,000 or 318, and it's a 70% sub. I think we established it was a 70% sub. So in order to gross that up, then we're going to be multiplying that by 100 over 70. So one way of doing that is to take the calculator, yeah, and to drop that sort of thing into the calculator. So we take here 318, we multiply that by 100, and then we divide that by 70, and therefore we get numerically the number of 454. We are leaving an audit trail. We're not just putting the numbers in the calculator and saying it's 454. Now, the next thing that I'm going to be talking about is getting a little bit more difficult. But I think at this stage, I've picked a lot of low-hanging fruit. I don't think I've said anything too radical, and I've probably earned myself 4 or 5 marks. So I feel quite good about, or you should feel quite good about what's gone on so far. Now, we've got this story about how the measurement of the fair value less cost of disposal excludes the cash flows associated with current assets and total liabilities because they generate independent cash flows. So it's the significance of this that the word excluded applies. So when we come to look at the net assets, when we come to look at the carrying value of the net assets, that's also going to be excluding the current assets and the liabilities to be consistent. To be consistent with the way that the, fair value less cost to sell have been determined, yeah? So look, there are various ways of doing this, and again, you could be using a spreadsheet, but I'm just trying to break it down and keep it simple and avoiding opening up too many items, too many screens. What we've got here is our PPE, which is at 2233. We're then going to include the intangible assets at 957, and then we're going to include the financial assets at 570, but we're not going to bring in, I suppose I could have taken a subtotal there if I wanted to. Let me just take a subtotal there of 3760. But what I'm not going to do is bring in the current assets. What I'm not going to do is take away any of the liabilities. But this needs to be adjusted for the fair value adjustment at the beginning, because these numbers are in the individual financial statements. So you're forgiven if you use 3760. I mean, you're almost forgiven if you use 2770. Yeah? But actually, the correct number to use is neither of those, because you've got to take into account this fair value adjustment, which is still knocking around. And therefore, I'm going to use the calculator again. I'm going to use the calculator again. I'm going to take my 3760, and then I'm going to add on to that 190, and that's going to give me a figure for the carrying value here of 3950. 3950. That's going to give me the carrying value over here of 3950. Now, I'm going to do the impairment review process, and just to give me a little bit of presentation, I am going to do this in a table form, a quick little table form. If you really wanted to, you could do this in a you could do it as part of the pre-populated spreadsheet. That's fine. So we've got the carrying value of the assets. We know that the carrying value of the assets are 3950, and these figures, if you want to be neat about it, are in thousands. We then have got the grossed up goodwill, which we've already calculated to be 454. and then we can aggregate these together if we want to, or not even bother. We will then deduct away from that the recoverable amount, and the recoverable amount we know here is 3850 million, so it's 3.85. So that's going to be here minus 3,850, and this will then give us the impairment loss. This will then give us the impairment loss. Now, if you use your common sense, or if you use your calculator, I don't mind which you do, you can see that the amount of the impairment loss, that's 3,950, the amount of the impairment loss here is going to be 554. Now, part of me wants to really slow down, but part of me just wants to execute. I can see that the impairment loss exceeds the grossed up goodwill. Yeah, so all the goodwill is written off. Now, if all the goodwill is written off, the amount of the actual goodwill in the accounts, is only 318. So I'm answering the question holistically. The amount of the goodwill that I'm writing off here, so this is the goodwill impairment. The amount of goodwill I'm writing off is 318. Yeah, because that's the amount that was actually recorded, and that gets written off through the P&L. And therefore must be a minus number against the retained earnings, and there is no charge to the non-controlling interest. Now, in terms of that 554, what is a little bit weird is that you have allocated 454 of the 554 to the writing off of the goodwill, because that 454 includes the notional NCI. So what we're left with is a further write-off, a further impairment loss, and the further impairment loss that we're dealing with is 100. And this will be allocated to other assets, and we can talk about that in a moment. This is allocated to other assets and will be split with the NCI, and will be and is split with the NCI, because this is not dealing with the goodwill, this is dealing with the normal assets. And therefore, do you need to do this? How much do you need to show? It's a 70-30 percentage split. The loss is 100, and therefore, when we come to dealing with the impairment of the other, how is that going to work out? How is that going to work out? The impairment of the other is going to go minus 70 against the retained earnings, and is going to go minus 30 against the non-controlling interest. Now remember that we're excluding the current assets, we're excluding the liabilities. So when I look at the reality of the question, the only assets that we can allocate this against are the non-current assets. The only assets that we can allocate this against are the non-current assets. I am pausing for a moment. I am going to continue briefly with writing a little bit more, but I just want to take a rain check. Everything I've done is correct. There's more I could do, but everything I've done is correct. And if I look specifically at what I have been processing here in the pre-populated spreadsheet in answer to part D, I've put 5 numbers in. I've earned 5 marks. I've put 5 numbers in. I've earned 5 marks. There are 10 marks available for this part D, part B here. 10 marks available. But in the marking guide, I think there was something like 13 marks, or 13 different ways of earning those 10 marks. I feel confident that I've got 9, 10 of those marks already. Now, what I will say very briefly, yeah, other assets. So I'm just going to extend it. We've put this to PPE. No, actually, strictly speaking, we put this to non-current assets, and that is 100. And we've split it with the NCI, and that was 30, split with the group retained earnings. And this is therefore just giving you a very slightly neater, better answer. And if I'm really, really strict and I want to get my sort of 10th mark, I could pick up on the fact that one of the assets is a financial asset, and therefore, strictly speaking, yeah, the loss would not be allocated. Yeah, the loss would not be allocated to the financial, but actually would be split between the PPE and the intangibles on a pro rata basis. I am not going to do that. I mean, really, really, really well done if in your answer you were discussing this point. I mean, it's fantastic. I think it is probably poor exam technique now to be going on and trying to calculate that split. It's in the model answer. The split is in the model answer. If you're interested, go to the model answer, have a look at it. I am doing a live debrief of this question, trying to get you through the exam. We've earned enough marks. We've got 9 out of 13, 9 out of 10, 10 out of 10. Yeah, it is time to move on. The big enemy in this exam is not the most complicated point in the question. It's finishing 4 questions within 3 hours and 15 minutes. JMO. It stands for just move on. So sometimes we're going to have to let these little things go. I repeat, it's all set out in the model answer, how that pro rata stuff is done. But it doesn't prevent you from earning the full marks, the 5 marks, yeah, on the pre-populated spreadsheet for doing that. Fantastic. And I move. And we move by looking at the next part of the requirement. Yeah, and the next part of the requirement is Exhibit 3, where we are explaining with calculations how the purchase of additional shares in Freeman should be reflected in the group accounts. In theory, there's one of 2 different ways. You could either have a step acquisition if you're going to gain control, or if you've already got control, it will be a control-to-control transaction. We've already got control back in X2. We've got a 60% sub. So we had a 60% sub with, therefore, a non-controlling interest back in the day of 40%. This was 4 years ago, 5 years ago, whenever it was, Jan X2. Now, at that time, the net assets were 1.58, but that's not quite the full story, because when the net assets were 1.58, they also had a brand name that had a fair value of 200,000. So we've got to be aware that we're given at the date of acquisition both the net assets and the fair value, presumably. Yeah, I don't know what we're going to have to do here. And at the date of acquisition, the NCI is 850. So again, at the date of acquisition, the NCI is given to us at 850. Now, we are where we are in X5, which is X2, X3, X4, X5, 4 years later. We've got a carrying amount of the net assets of 2.42. That's in the separate financial statements. And now we're buying, now I understand it, now we're buying 30%. Now we're buying 30%. So we've got a reduction in the NCI. We've got a reduction in the NCI because we are buying 30/40ths of the NCI. And the consideration that we paid is 1.25. Oh, do you recognise that number? Do you recognise that number? There it is. In our pre-populated spreadsheet, yeah, the 1.25 has popped up, yeah, the 1.25 has popped up here. So all that they've done is when they bought the additional 30% is they have credited the cash and they have debited the investment. They've prepared the draft accounts, including it as a 60% sub. They've made no entries. You see where I've anticipated that. They've made no entries other than that. Right, 6 marks. 6 marks. I've got to do some calculations, but I've got to do some explaining with calculations. First thing I'm going to do is explain. This is a control-to-control transaction. There is no change to goodwill. The non-controlling interest is being reduced. There is no profit or loss to the group, as this is a transaction within group equity. This is a transaction within group equity. A difference will arise that is taken directly to equity, i.e. will impact on other components of equity. Now let's try and work out what that difference is going to be. Let's try and work out what that difference is going to be. We know the amount that we have paid. We know that the cash that has gone out. Yeah, we know that the amount of the investment, we know the amount that has been paid is 1.25 million. So we know that amount as our starting point. And we then have a I just want a little bit of workings there. We then have a change in the non-controlling interest, don't we? And we know there's a decrease in the NCI, and we then know there's a decrease in the NCI, and the decrease in the NCI is going to be 30/40ths of the NCI balance at the year end. Now I don't know what that figure is. I know the figure at the beginning, but I don't know the figure at the end. Then I have a difference, and this difference, this difference goes to equity. This difference goes to equity. This difference goes to other components of equity. Could be a positive, could be a negative. Don't know. What I do know is I'm going to remove this, from the investment. I'm going to go into my spreadsheet, and I'm going to make an adjustment here that I remove that investment, because that investment doesn't exist as a group asset. It's an internal transaction. So I've got to remove that 1,250. When you're dealing with pre-populated spreadsheets, although you are not necessarily showing journal entries, although you are not necessarily having to debit and credit, underneath you're seeing an equality that you see in a statement of financial position uniquely. You can see that the adjustments we've previously made have been adding or minusing to the top and the bottom by the same amount. So, time out. 6 marks. 6 marks for part C here. I've already earned 1 mark here for part D. I've already earned 1 mark for part D. The 6 marks here in the marking guide, there were 8. Now, I suspect I've already earned maybe 4 or 5 of that 8. Everything I've done is correct. My spelling isn't correct, but it's not a spelling test. It's clear what we're doing. It's clear what we're saying. It's fine. The NCI is being reduced by 30/40ths. If you walk away in the exam, if you JMO in the exam at this stage, so you don't fall behind in the next question, Happy days. Good exam technique. But I'm here to debrief the question. I'm here to get the answer right. I'm here to explain how the really good students can push on and still earn that extra little mark or two. But don't beat yourself up. Don't be obsessed. What are we left with? I think what we're left with is the problem of not knowing what the closing NCI balance is. So we've got to work out the closing NCI balance. And I don't know, how messy is this going to be? How complicated is this going to be? What we've got is the opening balance. What we've got is the opening balance given to us in the question. And in a strange way, I wouldn't blame you if you just use that number. But I repeat, even if it takes me a long time, I'm going to get this answer right. I'm going to explain it to you. So we've got the opening NCI balance at 850,000. Yeah, at 850,000. I've got to be a little bit careful with my consistency with numbers here. We've got the opening balance out of 850. Now that opening balance will go up, yeah, by the NCI share, of the post-acquisition. Now the NCI share of the post-acquisition is going to be as represented by the rise in the net assets. It's going to be as represented by the rise in the net assets. Now the NCI percentage is 40%. The year-end net assets that we have got at the moment is 2.42, get it right, 2.42, 4.2 million. And then we can deduct away from that the net assets that we have at the beginning, which is 1,580,000. But that in itself would still be incorrect, because the net assets at the beginning need to take into account the fair value of the brand. Yeah. So actually the net assets at the beginning would actually then go up by a further 200,000. Yeah, for the fair value adjustment. Yeah, that should be a plus. And that means the net assets at the end is the figure given to us in the separate financial statement. So the fair value adjustment hasn't been taken into account. So we would therefore add on the 200,000. Now, if it was land, it makes no difference. But this is something which has an estimated useful life of 20 years. How many years have lapsed? You bought it in X2 at the beginning. Your year end is 31st December X5. That is 4 years. 4 years have lapsed. So therefore, we can take in 16/20. Oh my God, you're a genius if you've got this correct. Yeah? If you did this question in the time allowed, massive respect if you've got this level of detail. You're probably either not doing it, or if you're doing it, getting it wrong. But it doesn't matter if you get it wrong if you leave an audit trail. Because if you leave an audit trail, you will be picking up marks. So I'm just going to give you the number, which is 320, which means the closing balance of the NCI, is the original balance of 850, plus the share of the post-ac, which is 320. And therefore, when you plug that into your calculator, when you plug that into the process, you get a figure of 878. And that is the decrease in the non-controlling interest. So the NCI is going down. The NCI is going down by 878. The NCI is going down by 878. And then you've got a difference. And you can sort of work out what the difference is between those two numbers here, or you can work out the difference between these two numbers here. You've paid a lot more than the NCI has gone down. You've paid a lot more than the NCI has gone down. You've paid an extra 372. That makes me sad. That is a negative figure. That's a negative figure. that goes to other components of equity. The decrease in the NCI is a decrease in the NCI. So we've got a negative figure here of 372 in your pre-populated spreadsheet. So let me just put that into our pre-populated spreadsheet, 372, and therefore that's in brackets. What you do not do now is come up with a total column. What you do not do now, because there are no additional marks for completing the pre-populated spreadsheet. JMO, you must move on. Okay? So look, I am being realistic. I hope you know where I'm coming from. I'm passionate. You must do question 1. You have to. You've got no choice. But don't spend an hour and a half on it. Don't spend 2 hours on it. Don't be a perfectionist. Perfection is overrated. You have access to a beautiful answer. You have access to the marking guide. And you have access to me having worked this question through. And I have shown you in that dirty way, in that practical way, in that sweaty way, in that slightly imperfect way, how I have put my answer together. And of course it would look just a little bit neater, if that was like that, and move on. This is clear. So thank you for staying to the end. Make sure that you also engage with question 2 and question 3 and question 4 of this mock. Don't just do question 1. And all of those other questions I have also properly debriefed. All right. I particularly like what I've done with question 4. Because, that's for you to do. You do question 4 of this mock and you have a look at that debrief. And I'm very proud of the approach that I've taken. I think it's really going to add value. Don't put all your eggs in one basket. Don't just revise question 1. Revise the whole syllabus. Enjoy. My name still is Tom Clendon. I am still passionate about helping students pass their SPR exam. Thank you. Thank you. Thank you.